Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Dave Sequeira highlights pandemic-related trends. We find opportunities in a promising market. Christine Benz reminds us of an important deadline coming up. And we find a telecom stock that stands out amongst its peers. Let's get started. Dave Sequeira from Morningstar Research Services predicts the future of the economy based on pandemic trends. Within the first 90 days of 2020, collectively, our plans changed. Many bustling cities became ghost towns as lockdown orders went into effect. Restaurants closed, travel demand plunged, and many workers left their offices to begin working from home. Investors may have started wondering what this means for the future of the economy. Morningstar's chief U.S. market strategist, David Sequeira, believes the pandemic's long-term impact on economic growth will be minimal. However, the health crisis has ramped up the adoption of budding consumer trends. We think some industries have become overheated, but others are being overlooked. Let's start with the future of work. Our estimates found 45% of employed U.S. workers were working from home at the peak of the lockdowns. Remote working came with new challenges, like technology access and children at home. However, many thrived in this new environment. So will this new trend continue?
While we do expect growth in the full-time remote workforce, we anticipate many workers will return to their offices in a hybrid model, working a few days in the office and a few days at home.
Investors quickly realized the work-from-home trend would benefit tech companies. But Morningstar is recommending investors tread carefully as tech has ascended into overvalued territory. Some company valuations imply unrealistic future scenarios. Travel demand plunged due to travelers canceling business and leisure trips during the pandemic. Planes were grounded, hotel occupancy dropped, and many commuters stopped commuting. Oil prices briefly traded at an unthinkable negative price in April 2020. That means oil producers had to pay buyers a price to take oil off their hands as storage facilities filled up.
In the short term, we believe leisure travel will rebound more quickly than business travel. Car trips will outpace flights. Local travel will outperform international. But in the long term, we're anticipating most travel and travel-related sectors will return to pre-pandemic levels in 2023.
The coronavirus crisis has created an inhospitable environment for the restaurant industry. Shutdowns and social distancing cut total industry revenue in half in March 2020 compared to pre-pandemic levels. Eat-in restaurants recouped some sales as eateries reopened by the end of June. However, their revenue still paled in comparison to pre-pandemic levels.
The $2 trillion CARES Act helped many restaurants survive while learning to adapt. They revamped their operations to handle an increase in takeout and home delivery orders. This trend towards takeout and home delivery was already capturing a larger share of restaurant business before the pandemic. Those restaurants that are best positioned to survive have healthy balance sheets, are able to offer customers robust digital ordering, and have the ability to expand their delivery and drive-through capabilities.
Growth in online sales accelerated as people quarantined at home and many traditional brick-and-mortar retailers closed their doors. This chart shows the surge in non-store retailer sales between February and September 2020. Numbers from the U.S. Census Bureau show total retail sales only rose 7% during the same period.
Rising online sales had shown brick-and-mortar stores what they need to do to survive in this new competitive environment. They must provide a competitive online presence, but they also need a combination of convenience, a premium shopping experience, and the service to attract customers to their physical stores.
The pandemic has had broad impacts on our society and has accelerated some consumer trends. These trends created numerous investment opportunities, and while some of those are already gone, there is still value to be uncovered. Go to Morningstar.com to discover those opportunities. Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, here are stock picks our analysts like in the liquid biopsy market.
The liquid biopsy market may expand rapidly in the next 5 to 10 years, and we think it could significantly change how cancer is treated. Liquid biopsies are a non-invasive method of analyzing tumors using fluids, such as blood. We think they may allow cancer to be detected sooner, enabling earlier stage treatments, where survival rates are higher and treatment costs per patient are lower. In general, we see a host of incentives for end users, practitioners, and payers that could lead to the widespread adoption of these tests. We estimate that the liquid biopsy market opportunity for early cancer detection could eventually exceed $70 billion in the US alone, with global demand expanding that opportunity even further. We cover 3 potential leaders in liquid biopsies for early cancer detection. First, Illumina, through its pending acquisition of Grail, could become the first mover and long-term leader in pan-cancer biopsies for multiple cancers in one test. Currently, we view its stock as reasonably priced for its long-term growth opportunities. Exact Sciences could challenge Illumina in pan-cancer in about 5 years. But before then, it will likely face competition from liquid biopsies in its legacy business, a stool-based test for colorectal cancer. That keeps us cautious about the stock. And as the potential first mover in liquid biopsy for colorectal cancer, Guardant Health could threaten Exact Sciences and other traditional screening methods, such as colonoscopy. But Guardant's stock appears rich, given the uncertainty around that opportunity and its other liquid biopsies in development.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Next, Christine Benz and Susan Jabinski from Morningstar Inc. discuss IRA strategies before the April 15th deadline.
Hi, I'm Susan Jabinski with Morningstar. Tax day, which is April 15th this year, will be here before we know it. And that's also the deadline for making IRA contributions if you want them to count for the 2020 tax year. Joining me today to talk about some IRA strategies is Christine Benz. Christine is Morningstar's Director of Personal Finance. Hi, Christine. Thank you for being here.
Hi, Susan. It's great to be here.
Let's start out by talking a little bit about whether there have been any IRS rule changes regarding IRA contributions that people need to know about.
Well, the contribution amounts are staying the same for 2020 and 2021. So it's $6,000 maximum contribution if you're under age 50. It's $7,000 if you're 50 plus. That's staying the same. But one thing we see every year is a little bit of a change in the thresholds for eligibility to make contributions. So the income that you can have to be able to make Roth contributions or traditional IRA contributions if you want to deduct them on your tax return. So the traditional deductible contributions, the income limits are the lowest. They're a little higher for Roth. So check that out because we do see those change a little bit from year to year.
Let's say someone finds out that they are eligible to make either a traditional IRA contribution or a Roth IRA contribution. How do they choose?
Well, this is a fork in the road for a lot of investors in 401k plans as well, I should say. And so the key thing you want to think about, and admittedly, this can be a little bit tricky, but you're basically thinking about your tax rate at the time that you're making that contribution versus what you expect it will be when you pull the money out in retirement. So for younger investors whose incomes aren't very high today, especially if they think their career is kind of on an upward trajectory, this is a fairly easy call. I think that the math would tend to favor the Roth contributions. On the other hand, the example I sometimes use where a traditional deductible contribution is warranted is the older worker who hasn't managed to amass a lot of retirement savings, where their income is fairly robust, but they can still make that deductible contribution. In that case, the deduction that they would get with that pre-tax traditional deductible contribution, that's more attractive for them. So it's tricky, especially for younger people, but you want to think a little bit about that issue. And so, then for some investors, Susan, especially higher income folks, they may be shut out of direct traditional deductible IRA contributions and direct Roth IRA contributions. Their only option is to make a traditional IRA contribution, which they won't be able to deduct on their tax return because they earn too much, and then they can do what's called a backdoor Roth IRA conversion or make the contribution through the backdoor.
So the backdoor IRA contribution is still an option for people?
It is. It's alive and well. And I'll just run through this one more time, Susan, for people who aren't familiar with what this means. But this basically means that if you earn too much to make a direct Roth IRA contribution, you can still make that traditional IRA contribution. It's non-deductible. And then shortly thereafter, after you've funded that traditional IRA, then you convert to a Roth IRA. Get some tax advice here because there are some things you can run into, specifically if you have other rollover traditional IRA assets, you want to be careful. So get some tax advice before embarking on this. But the idea of doing that conversion is that you can get some money into a Roth IRA, even if you earn too much to make direct Roth IRA contributions.
Now, one thing that might have flown under the radar for some people is that the Secure Act did away with the age limits on making traditional IRA contributions. So if you are an older investor and you are thinking about making a contribution, what do you need to know?
Right. This question comes up a lot. And the key thing I would say is that for older investors, especially ones who are subject to required minimum distributions, the key thing you need to know is that you need earned income to make a Roth IRA contribution or any IRA contribution. And so that is a key dividing line for a lot of older adults where if they don't have earned income, instead all their income is coming from Social Security or coming from their portfolio, coming from required minimum distributions, they cannot make any sort of IRA contribution. What the Secure Act did is that it opened up traditional IRA contributions to older adults. Previously, anyone could make a Roth IRA contribution regardless of age. Now, traditional IRA contributions are opened up. My bias is for older adults who do have earned income that in most cases the Roth IRA contributions would tend to make more sense. The key reason is that if you make a traditional IRA contribution later in life, you're contributing to that amount of your portfolio that's going to be subject to required minimum distributions. If not right now, then eventually. But Roth IRA assets currently are not subject to those RMDs, which tends to mean, in my mind, that Roth IRA contributions are generally preferable in this situation.
And lastly, Christine, one thing you've talked about in the past is that IRA contributions, new contributions, are a great way to upgrade your portfolio. What do you mean by that?
I love the idea of people using their new IRA contributions to address problem spots in their portfolio. So if you are someone who's looking at your portfolio today and say, you know, I probably am a little bit too aggressive given my age, it's not a bad time to look at adding those funds to safer assets. Or perhaps you're someone who is underweight foreign stocks, and we've been hearing a lot about how foreign stocks might be relatively attractive over the next decade alongside US. Well, you could direct your new contributions to foreign stocks. So start with a little bit of a view of your portfolio, look at your portfolio's exposures, and use them to help you decide where to direct your new IRA contributions. If you have holdings that are sort of all-in-one holdings that you're perfectly happy with, that's fine too. Just keep doing what you're doing. But for investors who have discrete holdings in their portfolios, I think this is a good opportunity to top up areas where you may be underweight.
Well, Christine, thank you for all of these super IRA contribution ideas today. We appreciate your time.
Thank you, Susan.
I'm Susan Jabinski with Morningstar. Thanks for tuning in.
Lastly, here is why we think BCE is a strong alternative to other Canadian telecom companies.
The pandemic has materially affected the businesses of Canada's wireless carriers. Not only do we believe the industry in general is poised for dramatic business improvement when the pandemic ends, but we think BCE's business in particular is best positioned among its peers. We think it's favorably positioned in both wireless and wireline. Over much of its wireline footprint, we think BCE is now a strong alternative to other cable companies, including Rogers, its primary competitor. Historically, BCE's copper-based network has offered less quality than cable competitors for television and broadband service. However, over the last several years, BCE has been building out fiber to the home, which now passes about 5.5 million homes and businesses. With its anticipated fiber to the home build-out now 60% complete, we believe it is substantial enough to impact results in the near term, and we think the runway extends for several years as it continues increasing the number of homes it passes. The company eventually intends to pass 9 million to 12 million homes and businesses. It is also looking to upgrade service to more rural locations with its fixed wireless offering, which is now available in over 400,000 locations. On the wireless side, BCE and TELUS, which share a network, have consistently been rated as having the top Canadian networks over the last few years. However, we don't think BCE faces the same geographic pressure as TELUS does. Over the last couple of years, Shaw has re-entered the wireless market and has aggressively pursued customers, offering high amounts of data for very low prices, with the best deals available for Shaw's wireline customers. Little of BCE's wireline footprint overlaps with Shaw, so we see it as less susceptible to Shaw's insurgence. We think BCE is well positioned to continue adding customers at an industry-best rate, and when the pandemic ends and travel resumes, there is significant upside to sales with the return of roaming revenue.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.